let's use the DuPont method of analysis to examine the return on equity for Walmart versus Macy's. To begin with, we calculate the profit margin for Walmart and Macy's, and we see that Walmart's profit margin is lower than Macy's. It only earns 3.3% profit margin on its sales, and Macy's earns almost 5%. So in this regard, Macy's appears to outperform Walmart. But our next ratio that we consider shows really a difference in the philosophy that Walmart uses relative to Macy's. And that's in asset turnover, which you'll recall is sales divided by assets. So this asset turnover ratio tells us that Walmart sells almost 3 times its asset level every year. So 2.7 times its assets. Macy's sells 1.1 times its assets. In other words, per dollar of assets, Walmart sells much more than Macy's does. They have a basic retailing philosophy of charging low prices, meaning low profit margins. This is Walmart, charging low profit margins, but moving the inventory off the shelves in a hurry. So when you combine the profit margin and the asset turnover, we discover that Walmart has a higher return on assets than Macy's has. The last element that we consider in this return on equity is the level of debt that the firm uses, and we see here that Walmart has more debt in its capital structure than Macy's does. Walmart may be more comfortable with more debt in its capital structure because it has a fairly strong franchise and probably more dependable earnings. When the economy lags a little bit, Walmart doesn't suffer as much as Macy's does. In fact, their relative performance improves significantly in a down market. So we can see the Walmart versus Macy's business philosophy played out in these ratios, where Walmart has lower profits, charging less for its goods relative to what it paid for it, so lower profit margins, but it sells a lot more inventory over the course of the year, and it uses higher debt levels.